Welcome back. Well, the SGX Nifty is higher. I mean, that's a norm these days. Up by about 59 points. 14,435 is what it is showing. Gautam Duggad is joining us from Motilal Oswal. Gautam, good morning. Thanks for joining us. Let's start with IT because TCS came out with those blockbuster numbers. What would be your call now on stocks like TCS? And do you think this 30 times is going to be the new normal?
Hi Anuj, good morning. Yes, I think IT throughout 2020 has done exceedingly well. We've been overweight on this by almost 300 bips and we are continuing that. So in April is when we went overweight. Our overweight position in the model portfolio in IT at one time had gone up to 500 bips and now it is 300 bips. I think the fact remains clear that if market itself is trading at a slightly higher valuation and premium to its long-term average, then IT companies, especially tier 1, which has a fantastic balance sheet, very high FCF to PAT conversion, and continues to return cash to shareholders via multiple methods, then they deserve to enjoy these higher valuations. Secondly, look at the business model itself. The pandemic has actually acted as a tailwind for them. The whole digital transformation thing, the size of the deals that we are seeing in the top 5 IT companies, and a commentary by this big companies throughout the last 3 quarters, doesn't leave any doubt in my mind that we are entering a new tech spending cycle, and therefore multiples can remain slightly elevated. The important thing to know is, at least within tier 1, there is very little to choose between TCS and Infosys. While people keep debating, this is 10% premium to Infosys, that is 10% discount to Infosys. But the fact remains that both of them are doing exceedingly well. Infosys, which should report in another 2-3 days, we are actually expecting them to revise the guidance further. And they are also going to break the 5,000 crore quarterly profit mark. So we remain quite positive out there. It is the single largest overweight for us in our model portfolio.
Okay. Good morning, Gautam. One sentence that stood out as a theme in your report is that drivers of earnings are incrementally changing in favor of cyclicals. I'm just quoting your report. Can you explain that? Therefore, would the tilt of incremental buying be more towards banks? And will you go down the line? I mean, everybody wants to buy an HDFC Bank and a Kotak Bank. Will you go down the line?
Lata, so what I mean by that is not just banks, but even auto, cement, metals. For example, in this quarter's earnings estimate, if you see, 2/3 of my incremental growth in our coverage universe is coming from metals and another 10-15% from cement. So 80% of the incremental growth in 3Q FY21 is being driven by these two sectors. In fact, to put it other way, the 17% growth that we are expecting in MOSL coverage will be just 5% if I take out metals and cement. Similarly, for Nifty, the 7% growth that we are expecting in profit will be 0% if I take out metals and cement. What we like and what has been our call since June is banks are going to drive the rally further. And if we see broad basing of economic recovery, I think the top 4 or 5 banks are right now sitting at an ample cushion with a PCR of 70 to 85%. So they are well placed to absorb even if slippages are slightly elevated in this quarter and next quarter. Secondly, if you are seeing demand coming back and corporates are going to invest, then there is a room for credit growth to also pick up. And who will benefit from this? I think the bigger benefits will come to the large private sector banks and SBI. Whether it is retail or corporate still remains to be seen. Secondly, the traditional definitions of retail bank have changed. I mean, if you look at the loan composition of HDFC Bank and ICICI Bank today, you will be surprised to see the salience of corporate and retail loans in those banks versus 5 years back. Incrementally, yes, we are more positive towards corporate sector banks like ICICI, SBI and Axis, while we continue to like HDFC Bank and Kotak Bank as a steady place. Aside of that, cement is my best cyclical bet. I have not really been able to get hold of metals or oil and gas stock for last 3 or 4 years. We've been underweight over there. But cement has been a relatively cleaner cyclical bet in my view. And this quarter also, we are expecting a 75% profit growth in cement. Not a single company in our coverage universe in cement is expected to deliver less than 40% profit growth. And lastly, auto remains a great cyclical. Specifically, within auto itself, if you are seeing the conversations and management commentaries, the stocks which are a derivative of global cyclical demand on auto, they are showing much more traction today than, say, domestic cyclical auto.
Okay, Gautam, hi, good morning. Happy New Year to you. Just to take this discussion on autos forward, I notice in your report that you have added Ashok Leyland in your in the automobile space. But this stock has run up quite a bit. For someone who's perhaps missed this rally, is there still more to go, particularly in the commercial vehicle space?
Good morning, Sonia. Happy New Year. Which stock has not rallied, Sonia, in
That's
auto?
true.
I take that point. The market itself has rallied, and within auto also we have seen so many stocks doubling or tripling from their bottom. The reason why we have included Ashok Leyland is clearly we feel that the CV cycle is about to turn, and that is the sense that we are getting not just from auto companies but also from the NBFCs which are playing in that segment. So yes, this kind of stocks, cyclical specifically, are always risky. You have to be far more cautious when you invest in them, and there is no difference this time around as well. Our thesis is that these stocks can continue to see more earnings upgrade as we move forward, and therefore we've added one cyclical auto stock, which is a play on CV cycle in our model portfolio. Otherwise, we've had a very strong overweight of around 300 basis point on M&M throughout 2020, which we are continuing this year as well.
Okay. Gautam, what about the financiers? I mean, CV financiers, for example, have seen a big rally, both Chola and Shriram Transport and other NBFCs. What would be your call there?
Anuj, we like Chola, but I know stock has almost quadrupled from where its low was in March. But again, I mean, these stocks have been battered for 2017-18 and large part of 2019. So the pendulum can, of course, swing towards the other side, and it is going to be very difficult to maneuver entry and exit points in those stocks. As far as NBFC is concerned, Anuj, our preference, as you can see in our model portfolio, we have persisted with HDFC Limited, which has done well. And then we have also had some of the non-lending financials like ICICI Securities, which is part of the model portfolio, which we have liked. And within insurance also, we've had a stock in our preferred basket. SBI Life is one name. But yeah, to answer your specific question on CV financiers, Chola is what we like, while recognizing the fact that most of the stocks have had a tremendous run in the last 6 months.
Well, lest we run out of time, Gautam, two cautionary things have come on the table today. One, the Reserve Bank will push up the lower end of the interest rates. No longer will people be able to raise money at 3.5% and 4% perhaps. And secondly, you have this Gadkari ire over steel and cement. Are these going to be, dips which you will buy?
Specifically on the RBI part, I think that's a good decision, Lata, because the short-term rates had gone way below the repo rate, and repo rate had become meaningless, so to say. So therefore, some sort of sanity rebalancing, it's a good thing. And also it's a sign that things are normalizing faster than what we had envisaged. So depending on where you sit, you can look at it either ways. If you are, if you are worried about the impact on short-term asset prices, of course, you will be a little more, worried about this development. But I think from a broader point of view, from a big picture point of view, this is a welcome development. As far as steel and cement is concerned, Lata, to be honest, this sort of things have come often in the past as well. The statements were made. What is important to note is what actions eventually manifest in these two sectors as far as pricing is concerned. Till that time, it is very difficult to say anything. For the moment, I'm just seeing that in our coverage universe, cement is doing exceedingly well. Last quarter has been phenomenal. This quarter, we are expecting 75% profit growth, and next quarter is also going to be pretty strong. And I think that the cement prices have been fairly stable over the last 6 months. Metals, we are expecting a 4x growth in profit for this quarter on a very low base, of course. And I noticed that every 15 days, my analyst is raising estimate on the metal stocks given the underlying commodity price movement. So yes, stocks have run up a lot. Such sort of developments always come as a bit of a headwind for the near-term stock price movement. But I mean, as I said, cement is something we continue to like, and we will steer clear of metals and oil and gas in the commodity basket.
Okay, Gautam, it was a pleasure speaking with you. Thank you so much for joining us and giving us your views. That's on the markets, but the biggest headline has been the blockbuster numbers from TCS.